Hello and welcome to Stock Market Fever. Today is Monday, May 9th, and once again the broad stock market was hammered. The Dow closed down over 650 points today for about a 2% loss, following a 1,000-point drop last Friday, reflecting growing fears of an impending recession caused by runaway inflation and an aggressive Federal Reserve Board playing hardball catch-up following a policy of being too loose with money supply and too easy on interest rates. Tech stocks have been particularly hard slammed this year. Witness the utter smashing of Facebook, Netflix, Shopify, Nvidia, and so many more after reporting earnings misses or weak guidance. And even stocks that reported great earnings, such as Tesla, have been hammered. And today, after the close, the market once again pummeled the shares of another stock reporting weak guidance, and that company is Upstart Holdings. Upstart describes itself as an AI lending platform partnering with banks and credit unions to improve access to affordable credit. The company, which employs artificial intelligence to make loan determinations, now anticipates $1.25 billion in sales in 2022, but it had previously predicted revenue of $1.4 billion. Upstart Holdings Inc. stock dropped like a rock by about 46% in after-hours trading Monday after the downward revision of future revenues was announced, saying that the current macroeconomic situation will weigh on loan volume. On the earnings call, CEO Dave Gerard indicated that, quote, on the margin, a whole bunch of people that would have been approved are no longer approved, and thus the lower revenue forecast. Gerard explained, so there's a whole bunch of loans that just never happened at all. And there's a bunch of people that are still approved, but the interest rate is a few percentage points higher, and a certain fraction of them are going to decide that's not the product that they want. Additionally disconcerting, Chief Financial Officer Sanjay Datta observed that delinquencies were unusually low for around 18 months, but the trend has reversed due to the end of government stimulus, enabling borrowers to make payments in the past. Leading into today's conference call, Upstart had closed Friday at $83.89 and finished lower prior to the announcement at $76.23. But after the announcement, their share price was absolutely blown away, with the bid lowered all the way down to $42 and the ask only 2 cents higher. Upstart stock has been on an amazing roller coaster ride over the last couple of years. If you had purchased Upstart in January 2021, you would be long at about $22 a share. And if you held on, you would have seen Upstart blast off all the way to over $400 per share last September. But if you decided to get on the Upstart bandwagon at that time, your $400 investment would now be worth about $42 based on the closing bid. Is Upstart oversold? Will Upstart bounce back? Or was the stock still way overvalued, even on last Friday's close of 76, and now it's back down to earth where it belongs? And what does this market slam down portend for other consumer financials? Will they too suffer a drop in value as share owners head for the exits in anticipation of possible weak guidance slamdowns? And what about the overall market meltdown? Is there no end to this whirlpool sucking the sentiment and value out of our corporate and personal wealth? And might this market meltdown, paradoxically, lessen the need for the Fed to squeeze the money supply and raise rates higher? Did Fed Chairman Jerome Powell succeed by just threatening to ratchet the money supply tighter and raise rates higher? Will the consequential softening of home prices, combined with the stock market convulsions, end the need to actually do the tightening? And might that paradoxically give rise to consumer and investor sentiment, and thus the markets to follow? Please leave your thoughts and comments below, as we'd love to hear from you. And please be sure to like and subscribe for future actionable stock market alerts right here at Stock Market Fever.